Okay, let's unpack this. Welcome to another deep dive. If you're driving, prepping for a big meeting, trying to make sense of macro trends, or just insanely curious about how the world actually works behind the curtain, you are in the exact right place. We have a massive stack of source material to get through today, and I am genuinely excited to share this with you because what we have here completely shatters a lot of the narratives you're probably seeing on your daily newsfeed.
It really is a phenomenal collection of intelligence.
Yeah.
What we're looking at today is, well, it's a triangulated reality.
Mm.
We have access to this massive dossier collated from institutional memos, open source intelligence, academic research, market flow trackers, and even predictive market odds. The goal here isn't just to give you more data. I mean, we are all drowning in data,
Yeah, completely drowning.
right? The goal is to cut through that noise. If we connect this to the bigger picture, we can extract the hidden signals and help you understand where the global economy, technology, and even human biology are actually heading.
Exactly. And the mission of this specific deep dive is to connect some seemingly completely unrelated dots. We're going to take you on a journey that starts with the surprising shopping habits of Gen Z teenagers at your local mall and takes us all the way down to the microscopic biology of a fruit fly's brain.
Which is fascinating, by the way.
Oh, it's wild. We're also going to look at how a famous sports team's valuation is secretly tethered to a geopolitical energy crisis, and how the future of artificial intelligence is actively breaking the software you use every single day at the office. So settle in because this is going to be a fascinating ride. Let's start with something that probably feels very familiar to you, but is undergoing a massive hidden transformation right now: physical retail.
Right. So the prevailing mainstream narrative for the last decade, and I'm sure you've heard this 1,000 times, has been the retail apocalypse. The assumption was a straight line, right? E-commerce swallows the world, brick-and-mortar stores die, and the suburban mall becomes an abandoned relic of the 1990s.
Yeah, just empty buildings.
Exactly. But the data in our intelligence memo tells a completely different story. We are seeing a massive resurgence in physical retail, and it is being driven almost entirely by Gen Z.
Wait, Gen Z? The digitally native generation? Every time I drive past my local mall, it doesn't exactly look like a booming hotspot. Are you sure this isn't just a tiny blip in the data? Because the idea that the kids who grew up with smartphones glued to their hands are the ones saving the physical mall seems completely counterintuitive.
I know, it sounds counterintuitive until you look at the actual transactional data.
Yeah.
The numbers are staggering. Shoppers aged 18 to 24 are currently making 62% of their general merchandise purchases in physical stores.
62%.
62. Compare that to shoppers 25 and older, who are only making 52% of those purchases in person.
Wow.
Yeah. Gen Z is actively, deliberately choosing the physical mall over the internet, and it's having a profound impact on the market. Class Mall Real Estate Investment trusts the companies that own the really high-end premium malls, like Simon Property Group and Martrick. They are absolutely thriving right now.
Okay, so if the data proves they're there, the question is why? Because I know they aren't going there to hang out at the food court and pretend they're in a 90s teen movie.
Right. It is vital to understand that this is not nostalgia. Gen Z doesn't remember the 90s.
Right.
This is a structural shift in the fundamental purpose of retail space. Malls are no longer just transactional points of sale. They're evolving into media and entertainment venues. The intelligence confirms that TikTok influencers are a primary driver of this in-store traffic.
So they're going there to film.
Exactly. These high-end malls are essentially becoming highly curated, perfectly lit, photogenic backdrops for content creation.
That makes so much sense. It's a set. They're going to a set. The material gives this great example of the Tyson's Corner Center in the D.C. suburbs.
Yeah.
You have 20-somethings going to the mall to buy a $29 lace top for a date that night, specifically because they are instant gratification shoppers. They want the item right now.
Yep, the immediacy factor.
But the transaction isn't the whole point. While they're there, they are documenting the entire trip on Instagram and TikTok. The shopping trip is the content. And brands are leaning into this incredibly hard.
They really are. A perfect case study for this is a brand called Edicted. They started as a purely online, digital-first brand selling trendy, fast fashion.
Right.
Now, they are expanding their physical footprint rapidly. They went from 0 physical stores to 11, and they're planning to open 14 more this year alone. They recently hosted a Valentine's Day event that perfectly encapsulates this new model.
Right, they didn't take out billboard ads. They offered freebies like roses, pink tote bags, free cups of matcha, and advertised the entire thing exclusively through their social media feeds.
And it drew massive crowds of teenagers. The store wasn't just a place to buy clothes, it became a physical manifestation of their online
It's
community.
like a meetup.
Exactly. They hire college students as brand ambassadors, give them $150 worth of free clothing just to show up, do their makeup together in the store, and post videos. This is the new formula for driving foot traffic. You aren't selling a shirt. You're providing an experience that your customer can broadcast to their followers.
And it's not just the new fast fashion startups doing this. Legacy mall brands are riding this wave too. Pacsoon is expanding its physical footprint for the first time in 18 years.
18 years. Think about that.
It's crazy. Tapestry, the parent company of Coach and Kate Spade, is seeing double-digit sales growth in their physical stores specifically because of Gen Z. Their salespeople literally keep TikToks saved on their tablets so they can show young shoppers exactly how influencers are styling the luxury handbags. It is a total seamless integration of digital influence and physical reality.
Which brings us to a major corresponding pivot in the logistics space. This is where it gets really interesting for anyone analyzing e-commerce. As Gen Z demands instant gratification at the physical mall, the broader consumer market is actually moving in the exact opposite direction when they shop online.
Okay, how so?
The era of fast, free shipping is effectively dying.
This is a huge unwinding of what we've been taught for a decade. The whole Amazon Prime effect trained us to expect everything to arrive on our doorstep in 2 days or less, but the data shows that's reversing.
Precisely. A recent comprehensive survey from McKinsey highlights a massive shift in consumer preferences. Shipping cost is now the #1 priority for online shoppers. Speed, which used to be the ultimate deciding factor, has plummeted all the way down to 5th place on their priority list.
Fifth place. But why the sudden shift? Is it just inflation, or is corporate America actively reprogramming our expectations?
It's a bit of both, but primarily driven by corporate margins. The rising costs from massive carriers like FedEx and UPS are forcing retailers to abandon those generous shipping subsidies.
They just can't afford it anymore.
Right, they can no longer afford to eat the cost of 2-day shipping. So they are actively pushing customers toward 5 to 10-day delivery windows. They frame it as a saver option, but really it's margin protection.
Wow.
And here is a fascinating psychological twist. Retailers are tracking the data and finding that customers who accept these longer, slower shipping times are actually significantly less likely to return the items.
That is wild. It's almost like if you have to wait a week for something, you mentally commit to it more. Or maybe by the time it arrives, the manic impulse that made you buy it has faded, and you just accept the item.
Yeah, the buyer's remorse has time to dissipate.
Either way, this completely changes how you evaluate e-commerce giants.
It absolutely does.
Yeah.
For years, Amazon's logistics speed was considered an unassailable economic moat. The theory was that no competitor could ever match their 2-day delivery infrastructure, so Amazon would always win. But if the consumer no longer values speed as the premium deciding factor, if they care more about cost, that moat evaporates.
It totally levels the playing field.
Exactly. It levels it for decentralized e-commerce platforms like Shopify, which empowers independent merchants. If the customer is willing to wait a week for a cheaper product, the independent merchant suddenly becomes highly competitive against the Amazon behemoth.
So bringing this back to you, the listener, how do you actually use this information? It changes the investment thesis. The consensus view that physical retail is dead is factually wrong, which makes premium mall operators like Simon Property Group a compelling look.
Definitely.
But on the flip side, this same trend might be a disaster for premium athleisure brands like Lululemon. If Gen Z is treating the mall as a content creation hub, they need high-velocity, constantly changing, low-price, fast fashion that fits the rapid TikTok aesthetic. They aren't going to drop $130 on a single pair of black yoga pants when they can buy 5 different, highly recognizable outfits for their videos at a fast fashion retailer.
And let's take this one step further into the realm of behavioral finance and technology. Our intelligence dossier details a concept for a new type of fintech application called a precognitive wallet.
Precognitive, like Minority Report for shopping.
Basically, yes.
Okay.
This is designed to analyze your contextual data, the time of day, your GPS location, your recent digital activity on social media to predict and stop impulse purchases before they happen.
Okay, I am fascinated by this, mostly because I absolutely need it. Walk me through how this actually works.
Imagine you are scrolling through Instagram at 11:30 p.m. on a Tuesday. The app knows your location, it knows the time, and it knows your historical purchasing patterns.
It knows I'm vulnerable.
Precisely. It recognizes that in this specific context, you have a 90% probability of making a high-risk, unnecessary impulse by perhaps a new gadget or an expensive piece of clothing you saw an influencer wearing.
Guilty.
The precognitive wallet steps in and literally generates a discipline score. It might force a 24-hour cooling-off period, temporarily locking your digital wallet for that specific category of purchase.
It gamifies spending discipline. Instead of rewarding you for buying things, it rewards you for not buying things. But if something like this actually catches on, who loses?
The losers are any business models that rely entirely on low-friction, impulsive transactions. But the existential threat is specifically directed at buy now, pay later firms like Affirm.
Because their whole model is impulse.
Right. Their entire revenue model is built on capturing the consumer precisely at the moment of impulse and offering them an immediate, debt-fueled solution. If you introduce a friction layer that gamifies digital impulse control, you directly undercut the core revenue stream of companies built on consumer debt.
So you have Gen Z loving the instant gratification of the physical mall, while simultaneously a massive market is growing for tools to enforce digital spending discipline.
It's a fascinating tension.
It really is. And it perfectly illustrates why you have to look past the surface-level trends. Which actually brings us to our next major topic. We're moving from the physical realities of the mall to the geopolitical realities shaping global corporate governance. We need to talk about how international conflicts are secretly pricing the assets we think of as purely domestic.
This is where macro-level geopolitical risks become micro-level company-specific risks. The intelligence highlights a fascinating intersection of global conflict and sports team valuations. Specifically, we were looking at the Dolan Empire and the escalating tensions in the Middle East.
Oh, the Dolan Empire. This is a famously complicated Byzantine web to untangle. We're talking about James Dolan, who controls an empire of 4 public companies. You've got Madison Square Garden Sports, Madison Square Garden Entertainment, Sphere Entertainment, and AMC Networks.
A massive portfolio.
MSG Sports is the crown jewel here because it's the company that owns the New York Knicks and the New York Rangers. But right now, MSG Sports trades at a massive, glaring penalty that Wall Street analysts call the Dolan discount.
To understand the sheer scale of this discount, you have to look at the underlying assets. MSG Sports has a public enterprise value of roughly $8.6 billion.
Okay, $8.6 billion.
However, rigorous independent valuations like the ones conducted by Sportico peg the true value of the New York Knicks alone at $9.85 billion.
Wait, the Knicks alone are worth more than the whole company.
Yes, and they value the Rangers at $3.65 billion. So combined, the actual teams are worth almost $13.5 billion.
Wait, so the public company is trading at an enterprise value roughly $5 billion less than the sum of its parts. That's insane. Why is the market penalizing them so aggressively?
The standard narrative I always read is just that James Dolan is an unpopular owner with terrible corporate governance. Is that it?
The internal corporate governance is undeniably a major factor, but it's only half the story. The Dolan family controls the voting shares, but only owns about 21% of MSG Sports. The various companies are so deeply intertwined that MSG Sports, the entity owning the incredibly profitable sports teams, is essentially subsidizing all the other entities.
How does that work in practice?
Well, MSG Sports pays rent to MSG Entertainment for the arena. They split the food and beverage profits. They pay commissions on merchandise sales. And they even pay for shared back office space.
So they're just shuffling money around to benefit the entities Dolan cares about more, like the Sphere. Essentially, yes. In a recent 6-month period, MSG Sports brought in $65 million from related party transactions, but paid out $83 million to those exact same related parties. They are running a net loss despite owning 2 of the most lucrative, prestigious sports franchises on the planet.
But you're saying that's not the real reason for the $5 billion discount.
It's the visible reason. But our intelligence memo points out a much more acute, hidden risk that the broader market is actively mispricing. The real danger isn't just internal accounting. It is severe geopolitical counterparty risk. MSG Sports and the broader Dolan Empire are deeply fundamentally tethered to Abu Dhabi and the United Arab Emirates.
Right. I completely forgot about the jersey patch. The Knicks literally wear an Experience Abu Dhabi patch on their uniforms.
It goes much deeper than a patch. Abu Dhabi has extensive multi-layered marketing agreements with MSG Entertainment, and their Department of Culture and Tourism is actively funding the construction of a brand new Sphere venue in the UAE, mirroring the massive facility they built in Las Vegas.
Okay, so they have a lot of Middle Eastern money flowing into the business. Why is the market quietly terrified of that right now?
You have to overlay that corporate exposure with the current geopolitical reality detailed in the intelligence. The sources highlight an escalating severe conflict with Iran. This conflict has severely throttled shipping lanes in the Strait of Hormuz,
Which affects oil.
massively. Because of this disruption, U.S. crude oil futures have surged 36%, hitting over $90 a barrel. To put that in perspective, that is the fastest rate of increase since 1983. We are witnessing a severe energy crisis and massive, unpredictable regional instability in the Middle East. The intelligence even notes intercepted chatter regarding private jet limitations out of the Gulf, which is a classic leading indicator of potential capital flight by the ultra-wealthy fearing a wider war.
Wow. So when MSU Sports recently announced they were exploring a potential spin-off separating the Knicks and the Rangers into two distinct public companies, the stock price naturally spiked. Everyone on Wall Street thought, finally, they are restructuring to unlock that $5 billion of hidden value. But you're saying our intel suggests that spin-off talk might just be a total smokescreen.
It's highly probable. The reality is that the Dolan balance sheet is now directly tethered to an active, deteriorating conflict zone. If the situation with Iran escalates further, those lucrative Abu Dhabi partnerships, and crucially the funding streams for the new sphere, could evaporate overnight.
Poof. Gone.
Exactly. The market is slowly realizing that investing in the New York Knicks right now is secretly a proxy bet on the geopolitical stability of the Persian Gulf.
That is such a brilliant distillation of why you have to look under the hood. It perfectly illustrates how macro risks become micro risks. You see a famous, beloved brand like the Knicks, and you assume a certain level of invulnerability. It's New York. It's basketball. But when you dig into the related party transactions and the geographical exposure of their business partners, the risk profile changes entirely. Do the sources have another example of how this kind of corporate structure blindness destroys value?
They do, and it's a stark comparison from the Asian markets. The memo compares two massive, historical, family-run conglomerates based in Hong Kong, Swire Pacific and Jardine Matheson.
Okay, let's break this down. For anyone unfamiliar, what are we looking at here?
We're looking at how a company's internal structure dictates its market valuation. We use a metric called the price-to-book ratio. In simple terms, this is what the company's actual assets, its buildings, planes, inventory are worth on paper versus what the stock market is willing to pay for the company.
Got it.
If the ratio is under 1, it means the market thinks the company is worth less than the sum of its parts.
Just like the Knicks.
Exactly. Now, Swire Pacific owns incredible assets, including Cathay Pacific Airlines and massive property developments. But they have stubbornly held on to a colonial-era management structure.
What does that mean exactly?
They use a trainee program where they rotate a small, elite group of generalist graduates through their wildly diverse businesses.
That sounds incredibly outdated.
It is. It is a highly inefficient model in the modern, specialized corporate world. Because they refuse to modernize their governance, the market punishes them severely. Swire trades at a massive discount, specifically a 0.42 price-to-book ratio.
So the market is saying, we love your assets, but we hate your management so much we'll only pay 42 cents on the dollar for them.
Precisely. Meanwhile, their historical rival Jardines faced a similar situation but made a different choice. They decided to modernize.
They actually adapted.
Yes. They abandoned the legacy colonial structure, hired specialized professionals for specific divisions, and streamlined their operations, the result of just fixing the internal governance. A 90% boost in their share price over 12 months, bringing them to a much healthier 0.79 price-to-book ratio.
Wow.
The lesson here is brutal and clear. Stubborn adherence to legacy corporate structures actively, tangibly destroys shareholder value.
That is a masterclass in value traps. But let me play devil's advocate for a second. Let's go back to that oil shock you mentioned. U.S. crude spiking past $90 a barrel because of Iran. If we are facing a massive energy crisis, doesn't that mean we should be extremely bullish on green energy? Surely Europe, which is highly dependent on imported energy, is using this crisis to accelerate their transition to renewables, right?
Logically, that makes perfect sense. To secure their own energy independence, you would assume a rapid acceleration of green policies. But the intelligence data shows the exact opposite is happening in real time. European political will for green energy initiatives is actually dissipating rapidly.
Wait, Europe is backing off its green goals. Why?
Panic over short-term economic survival. Faced with crippling high energy costs and fears about global competitiveness, European leaders are quietly watering down their climate regulations.
Really? How so?
They are delaying the planned phase-out of internal combustion engines, But more importantly for the markets, they are significantly weakening their carbon tariff, which is known as CBAM, or the Carbon Border Adjustment Mechanism.
Let's clarify that for the listener. What exactly is a carbon tariff, and why does watering it down matter so much?
A carbon tariff is basically a tax on imported goods based on how much carbon was emitted to produce them. It's meant to protect domestic European companies that are forced to follow strict environmental rules from being undercut by foreign companies that pollute freely.
Makes sense.
But because Europe is panicking about high costs, they're starting to carve out massive exemptions in this tariff for specific energy-intensive products, most notably fertilizers.
Oh, so they are just caving to the agricultural lobbyists to keep food prices down.
Exactly. And this is where the actionable intelligence lies. By creating a toothless carbon border tax and granting these exemptions, Brussels is inadvertently providing a massive unearned subsidy to U.S. producers.
Because the U.S. companies can now export to Europe without paying the tax.
Right. Suddenly, an American fertilizer company like CF Industries has a massive regulatory tailwind. Europe just removed a key competitive barrier for them.
So Europe is choosing short-term fossil fuel dependence to keep their factories running, which creates a really bearish, pessimistic outlook for the overall European economy. But it creates this weird, highly specific, bullish setup for certain U.S. agricultural and commodity players.
That is the core insight, and it reinforces the overarching lesson for the listener. You cannot take headlines at face value. A world-famous brand like the New York Knicks or a noble-sounding European green energy initiative might look like a great investment on the surface.
But there's always a catch.
Exactly. But if you don't dig into the deeply intertwined counterparty risks in Abu Dhabi, or the stubborn corporate governance of a family empire, or the political panic watering down international tariffs, you are going to walk right into a value trap and get burned.
Speaking of political panic and regulation, we are going to pivot now to the intersection of politics, regulation, and the markets. And before we dive into this section, I want to be incredibly clear with you, the listener. We are about to discuss some highly charged political actions. Both of us are completely impartial here. We are not taking any sides, we are not endorsing any viewpoints, and we are not injecting our own political opinions. We are strictly reporting the facts as they are documented in our provided intelligence and analyzing how these political shifts actively impact the financial markets and corporate strategy.
That is an essential disclaimer. We are analyzing policy solely as a market variable, and the sources outline a profound structural shift currently underway that the Federal Trade Commission, the FTC, under Chair Andrew Ferguson in this new Trump 2.0 era.
Okay, set the stage for us.
Historically, regulatory agencies like the FTC maintain a certain arm's-length independence from the White House. But the intelligence details that Ferguson has explicitly, publicly aligned the agency with the administration's political agenda.
Right, and this isn't just a subtle shift in tone. The FTC is utilizing novel antitrust and fraud theories to aggressively pursue what the sources literally describe as right-wing targets. They are launching formal investigations into corporate diversity, equity, and inclusion DEI programs. They are looking into transgender healthcare providers, and they are heavily targeting media organizations.
The media targeting is particularly noteworthy for the markets. For instance, the FTC issued a formal warning letter to Apple CEO Tim Cook regarding perceived bias in the Apple News app.
Oh, wow.
The implication was that suppressing conservative publications could be interpreted as a violation of consumer protection laws.
They didn't stop at Apple either. They issued aggressive subpoenas to Media Matters, a prominent liberal news outlet, and NewsGuard, a company that rates the reliability of news media. The FTC demanded internal documents, communications, and even customer names.
That's a huge overreach for a lot of legal scholars.
It is. The sources note that a federal judge actually stepped in and called the Media Matters subpoena a straightforward First Amendment violation. So you have this highly aggressive, explicitly politically motivated use of regulatory power.
But, and this is why the market analysis is so complex simultaneous to these politically driven actions, the FTC is also executing massive, mainstream populist enforcement against corporate monopolies.
So they aren't just playing politics?
No, they haven't abandoned their traditional role, they've expanded it. They recently settled a massive $2.5 billion consumer protection lawsuit against Amazon, alleging the company deliberately duped customers into Prime subscriptions and purposely made the cancellation process impossibly difficult.
The classic Roach Motel subscription model.
Exactly. And they hit Walmart with a $100 million settlement over allegations that they were actively misleading their delivery drivers about how much they would get paid. So it's a dual-pronged attack. It's not just one side of the aisle getting hit.
Correct. You have this unprecedented blending of traditional, heavy-handed corporate enforcement with explicit ideological targeting. So, what is the takeaway for a corporate board or an investor?
The takeaway is that political allegiance is now a core corporate governance issue. It is a fundamental risk factor. If a company maintains prominent liberal-leaning policies or have highly visible ESG and DEI commitments, they are now facing significantly higher regulatory headline risk than they were 3 years ago.
It completely redefines the concept of an economic moat. We used to think a moat was just a great brand or a cheap supply chain. Now, the new reality is that the regulatory moat around your business might depend entirely on your political profile and whether you are in the crosshairs of the current administration.
And this aggressive, unilateral approach extends far beyond domestic agencies. It is reshaping foreign policy, which directly impacts the supply chains of nearly every multinational corporation. The sources detail the administration's announcement of a new military coalition called the Shield of the Americas.
This is a pact aimed at combating drug cartels, right?
Yes, it's a coalition with a dozen Latin American nations designed to allow more direct, aggressive U.S. military operations and intelligence sharing within their borders to dismantle cartel networks.
Sounds like a standard anti-drug initiative.
Until you look at the details. The critical detail, the detail that the markets are reacting to, is who's excluded from this pact.
Right. The pact explicitly excludes Mexico, Brazil, and Colombia, and there were public threats of unilateral military action against Mexico if they refuse to allow U.S. forces to eradicate cartels on their soil.
The market impact of this friction is profound and immediate. First, consider the massive trend over the last few years of nearshoring.
Bringing factories closer to home.
Right? Hundreds of U.S. companies have moved their manufacturing out of China and into Mexico to secure their supply chains. This diplomatic exclusion and the threat of unilateral action creates massive geopolitical instability right on the border. If you are a company relying on Mexican manufacturing, your risk profile just skyrocketed.
Yeah.
Your supply chain is suddenly vulnerable to diplomatic collapse.
But where there is risk, there is also opportunity. Who benefits from a massive expansion of U.S. military operations in Latin America?
It creates an immediate alpha generation opportunity for specific sectors of the defense industry. The U.S. is simultaneously managing the Iran conflict in the Middle East and now pushing aggressively into the Southern Hemisphere. This requires different tools. Companies focused on light aircraft, tactical surveillance, and specialized special operations equipment are positioned for significant new government contracts.
And speaking of Latin America, I want to bring up this incredibly interesting small cap play the sources pointed out. It's an oil and gas exploration company called Geopark, ticker GPRK. If you just glance at their chart, the broader market views them as a very risky, volatile company, heavily exposed to the political instability of Colombia. But our intelligence flagged a massive hidden signal.
The 20% investment stake by the Galinsky family.
Exactly. The Galinsky family is incredibly powerful and wealthy. Why would they take a 20% stake in a struggling Colombian oil driller?
The intel thesis is that this is a strategic chess move. They want to use Geopark as a fully established corporate vehicle to enter a reopening Venezuelan oil market.
Which is huge.
Think about it. As the Middle East conflict with Iran makes oil from the Persian Gulf politically untenable and highly volatile, global capital will inevitably seek non-OPEC jurisdictions that have massive reserves. Venezuela fits that bill perfectly if the sanctions ease.
Geopark suddenly has this asymmetric upside, a potential monopoly position in a reopening country that the broader market is completely ignoring because they're only looking at the surface level Colombia risk.
That is a perfect example of looking past the headline narrative. Let's shift our focus from geopolitical activists to financial activists, because we are seeing a similar dynamic play out in the domestic food supply chain. The sources highlight a major move by the activist investment fund Starboard Value. They have recently taken a significant ownership stake in Lamb Weston.
For those who don't know, Lamb Weston is the absolute behemoth of the French fry industry. They are the largest producer of frozen potato products in North America. But they've been struggling lately. Their stock has taken a hit. Overall demand is soft because fast food menu prices have gotten so high that consumers are pulling back, and they've faced internal manufacturing cost issues.
And when a company like that struggles, an activist like Starboard Value steps in. Their goal is to aggressively force management to cut costs, optimize operations, and improve profit margins to boost the stock price. Starboard is publicly demanding that Lamb Weston double their current $250 million cost savings target.
Double it.
Double it. They're even suggesting that Lamb Weston should completely sell off their Asia-Pacific business division to raise cash.
Now, if you hold Lamb Weston stock, you might be thrilled. An activist coming into clean house usually means a quick bump in the share price. But the real insight here, the actionable intelligence, isn't about Lamb Weston itself, it's about the second-order effects on everyone else in the ecosystem.
Precisely. You have to ask, who does Lamb Weston sell to? They supply the massive fast food chains, companies like McDonald's or Restaurant Brands International, which owns Burger King and Popeyes. If Starboard successfully forces Lamb Weston into a slash-and-burn cost-cutting program to artificially boost profitability, that margin expansion has to come from somewhere.
It comes out of the hides of the buyers.
Exactly. It will likely translate directly into higher input costs, stricter contract terms, or even supply chain disruptions for the restaurant chains buying the fries. Therefore, the aggressive activist pressure on the supplier actually becomes a direct, hidden headwind for the restaurant chains.
The overarching lesson here for you, listening right now, is how to actually consume political and business news effectively. When you read an article about the FTC subpoenaing a media company or a new Latin American military pact or a Wall Street firm taking over a potato company, you shouldn't be reading it for ideological outrage or just as pure entertainment. You need to read the news as a map. It is a live map of changing regulatory moats, shifting supply chain vulnerabilities, and hidden margin squeezes.
We are now going to pivot to a sector where the mainstream narrative and the underlying reality are currently experiencing a massive, irreconcilable divergence. We need to look at the cryptocurrency market and the simultaneous rise of predictive betting platforms.
Here is where it gets really interesting. Because if you turn on CNBC or open any financial app right now, the dominant screaming narrative is that crypto is entirely back. Bitcoin is surging past $73,000. The crypto-related equities companies like Coinbase, Robinhood, and MicroStrategy are rallying incredibly hard. The media is universally attributing this to a broader risk-on sentiment in the market and, crucially, massive perceived political tailwinds.
The operating assumption driving this rally is that the new administration, specifically the Trump-aligned FTC we just discussed, along with a renewed push for stablecoin regulation, will create a highly friendly, permissive environment for digital assets.
Yeah.
The retail market is aggressively pricing in a structural, permanent victory for crypto based almost entirely on political rhetoric.
But our triangulated intelligence says this is a complete illusion. It's a sugar high. The smart money, the institutional capital that moves markets over the long term is not buying this narrative at all. And the proof isn't in opinions. The proof is mathematically hidden in the prediction markets.
Let's look at the actual data from Polymarket, which is a massive crypto-based prediction platform. This isn't a poll where people just give their opinion. This is a market where participants are putting their own real money on the line to back their predictions. What are the actual odds being priced in by people with skin in the game?
This blew my mind. The prediction market is currently pricing in a dismal 6.5 to 6.7% probability of a Kraken IPO happening by March of 2026. Kraken is one of the oldest, largest crypto exchanges in the world. If the regulatory environment was truly clearing up the way the headlines say it is, a Kraken IPO would be a slam dunk certainty.
A sub 7% probability signals extreme, deep-seated skepticism from actual market participants. It indicates that the fundamental structural hurdles of bringing a major, complex crypto firm public impasse, the intense SEC scrutiny, the auditing requirements, the liability issues remain insurmountable, regardless of who is sitting in the Oval Office.
It gets even more stark when you look at MicroStrategy. For those who don't know, MicroStrategy is ostensibly a software company, but under Michael Saylor, they've essentially become a proxy for Bitcoin because they hold billions and billions of dollars worth of the cryptocurrency on their balance sheet.
And the prediction markets currently give an 84% probability that MicroStrategy will not sell a single Bitcoin before the end of 2026.
Which sounds bullish at first, right? Diamond hands, they never sell. But what does it actually imply?
It implies illiquidity. The market believes these massive crypto holding companies are essentially trapped in their positions. The assumption is that they cannot liquidate any meaningful portion of their holdings without absolutely crashing the underlying market or inviting severe, catastrophic regulatory wrath. They are prisoners of their own massive stakes.
And if the prediction markets weren't enough to make you skeptical, we also have forensic data highlighting what the insiders are doing with their own personal wealth.
The intelligence memo tracked SEC Form 4 filings, which document when corporate insiders buy or sell their own company's stock. The data shows a massive concentrated cluster of insider selling at major tech and crypto-adjacent firms. We're seeing a consistent pattern of insider dispositions at Coinbase as well as at Snowflake, the massive cloud data company.
Now, to be fair, executives sell stock all the time to pay taxes or buy houses. It's often part of pre-planned, automated 10b5-1 programs.
That is true. However, seeing such heavy, concentrated insider selling by key personnel precisely during a politically driven massive hype rally warrants deep cynicism. When the people actually running the company are aggressively selling their shares into the spike, it signals a distinct lack of internal confidence and sustained long-term appreciation. They're cashing out on the retail hype.
So, the mainstream headline is shouting crypto to the moon. But the secondary indicators, the prediction markets, and the forensic insider trades are flashing massive bright red warning signs. The market is mistaking a short-term, tweet-driven emotional rally for fundamental, long-term regulatory clarity. Our sources are incredibly explicit on this. The actual trade here is to fade the move, do not buy the hype, look at shorting Coinbase.
This growing reliance on prediction markets to find the ground truth brings us to a fascinating evolution in how our society is learning to parse reality. Platforms like Polymarket and its major regulated competitor, Kalshi, are attempting something revolutionary. You want to turn any verifiable future event into a tradable, hedgeable financial asset.
They are operating on the theory of the wisdom of the crowd. The idea is that a large, diverse group of people betting real money will synthesize complex information and predict outcomes far more accurately than any single traditional pollster or pundit.
Kalshi is currently seeking a massive valuation of roughly $20 billion. But to justify that valuation and to truly capture the actual wisdom of the crowd, their internal data has forced them to realize a major structural flaw in their current business model. Put simply, they do not have the whole crowd.
Right. Right now, prediction markets are basically a monoculture. Sports betting accounts for roughly 65% of the trading volume on these platforms, and the active user base is overwhelmingly young, male, and highly engaged in finance or tech.
And you cannot have a perfectly efficient, truly predictive market if you are only sourcing opinions, biases, and data from one narrow demographic slice of the population.
So what is Kalshi doing about it? They are actively engineering a massive demographic shift. The sources point out that they are aggressively trying to recruit women to the platform. And it's working. They've grown their female user base from 13% to 26% in just the last 10 months.
The strategy they are using to achieve this is brilliant in its simplicity. They are paying female influencers to promote the platform, but more importantly, they are aggressively expanding their event contracts away from just sports and finance and heavily into pop culture, politics, and the broader economy.
It's fascinating. You log onto a financial derivatives exchange, and they are hosting bets on whether Taylor Swift will explicitly say the word ring during a specific television appearance. Or they have contracts on whether Ed Sheeran will release a #1 album in 2025. They are taking bets on what Melania Trump will say at the UN. They're literally hosting watch parties for The Bachelorette where people can live trade the outcome of the show.
To a traditional financial analyst, it sounds entirely trivial. It sounds like a casino. But the underlying strategy is profound. By lowering the barrier to entry with highly familiar, culturally relevant subjects, they are trying to train a massive, broader swath of the population to participate in the mechanics of financial forecasting. Once a user understands how to buy a yes or no contract on a pop star, they are far more likely to eventually transition into trading contracts on interest rates or election outcomes.
There is also a highly strategic, defensive regulatory reason for this diversification. Kalshi is currently facing intense legal challenges from states claiming their platform violates state sports gambling laws. By ensuring their platform hosts robust, high-volume markets on politics, culture, and macroeconomics, they are building a legal defense. They are trying to empirically prove to regulators that they are a legitimate financial derivatives exchange subject to federal oversight, not just a glorified digital sportsbook trying to skirt state gambling laws.
The core lesson for you in this section is vital for navigating modern markets. In a world drowning in noisy headlines, algorithmically generated outrage, and political hype, you have to look past the surface narrative. Do not buy a stock just because a politician tweeted about it or a cable news host yelled about it. Check the secondary indicators. What are the insiders actually doing with their own shares? What are the prediction markets saying the actual statistical probability of success is? That is where you find the unvarnished truth of the market.
And from the speculative bets on the future, let us turn to the technology that is actively, aggressively rewriting our present reality. We need to discuss the AI paradigm shift. And I don't mean chatbots writing bad poetry. We are talking about the transition from AI as a fun novelty to AI as the central autonomous orchestrator of the entire enterprise.
This is without question an adapt or die moment for the entire legacy software industry. For the last few years, we've generally thought of AI as a neat tool, a passive chatbot that you prompt to write an email, summarize a document, or generate an image. But the technology is rapidly moving into a new phase called agentic AI.
Okay, let's break this down. What exactly makes an AI agentic?
Agentic AI refers to autonomous agents that can actually reason, make decisions, and execute complex, multi-step workflows across different, disparate software programs without any human intervention or constant prompting.
Walk me through this. Give me a concrete example. If I am a middle manager at a company that uses Salesforce, how does my life change?
Let's look at the existential threat this poses to a massive enterprise software giant like Salesforce or Oracle. Historically, these companies provide the database what we call the system of record. In 2024, a human sales rep logs into Salesforce, clicks through 5 different screens, manually updates a client's file, pulls a report, and emails it to their boss. The human is the interface. But with agentic AI, the AI agent becomes the primary intelligent interface.
So the human stops logging into Salesforce altogether.
Exactly. The human worker simply tells the AI, update the Johnson account and send the quarterly projection to management. The AI agent then silently, autonomously pings the Salesforce database in the background via an API, retrieves the necessary information, updates the fields, drafts the email, and sends it.
And that completely breaks the economic model of the entire software industry. The entire software as a service, or SaaS industry, is built entirely on per-seat subscription pricing. A company pays Salesforce $150 a month for every single human employee who needs a login. But if an AI agent is doing the data entry work of 50 human sales reps, the company's not going to pay for 50 human seats anymore. They only need one connection for the AI.
Precisely. The power, the leverage, and most importantly, the revenue shifts away from the database, the system of record, and flows directly up to the AI, the system of orchestration. The company that owns the AI interface wins the enterprise, relegating today's massively valued software giants to the role of commoditized, invisible back-end data pipes.
That is terrifying if you are a SaaS CEO. And we are already seeing this kind of commoditization play out in the wealth management sector. The sources highlight a fascinating Financial Times report noting that over half of all adults in the UK are already using generative AI chatbots like ChatGPT and Gemini for financial advice and pension planning.
Over half. Think about the scale of that behavioral shift. People are actively using general-purpose language models for critical retirement planning, despite the well-documented fact that these models frequently hallucinate facts and make basic mathematical errors. It demonstrates a massive, overwhelming mass-market demand for low-cost, immediate, good-enough financial guidance.
But what does the AI actually tell them to do?
And this is where the ripple effects become fascinating. When a generic AI provides financial advice, it is programmed to be safe. Therefore, it is overwhelmingly likely to recommend the simplest, safest, lowest-cost financial products available, which are almost universally passive index funds and exchange-traded funds, or ETFs. The AI is highly unlikely to recommend a complex, high-fee, actively managed mutual fund.
So by default, the AI is effectively acting as a massive, completely unpaid global sales force for the asset managers that specialize in passive funds, primarily BlackRock.
Exactly. The democratization of basic financial advice via AI is a direct, massive structural tailwind for BlackRock, and an equally massive headwind for traditional human-led wealth advisory firms. Those human advisors rely on charging high fees for bespoke advice. Their margins are about to be absolutely crushed by a free chatbot that tells everyone to just buy the S&P 500.
So if the software layer is going to commoditize, how are the really smart institutional investors actually playing this AI build-out? The intelligence says they aren't just looking at the software code. They're looking at the hard, physical, incredibly unsexy infrastructure required to run these models.
Yes. The private equity giant KKR is currently preparing a multi-billion-dollar sale of a company that specializes entirely in data center cooling. Why? Because the AI revolution is creating an astronomical, unprecedented demand for sheer electrical power and thermal management. You cannot run a data center packed with tens of thousands of advanced GPUs processing AI queries without literally melting down the building unless you have massively advanced cooling systems.
KKR's exit from this private company is going to be a major market event. It's going to set a massive stratospheric valuation benchmark for the entire thermal management sector. The sources point specifically to a company called Vertiv, ticker VRT, as the premier publicly traded pure play in this space. The argument is that the broader market is still not fully pricing in what we can call the AI tax on physical infrastructure. Every single new data center built anywhere in the world requires an exponential increase in cooling capacity compared to traditional cloud storage, making companies like Vertiv essential, unavoidable picks and shovels plays for the AI gold rush.
I love the picks and shovels analogy. It's not about mining the gold, it's about selling the pickaxes. Now let's look at how smaller niche companies are desperately trying to pivot to capture some of this AI value. The sources highlight Angie Inc.
Formerly known as Angie's List. Historically, they have been a somewhat struggling, low-margin lead generation marketplace. You go to their site, you type in that you need a plumber, and they sell your contact info to local contractors. It's a highly fragmented, high-friction model. But recently, they launched an application that is natively integrated directly within ChatGPT.
And this is not just a PR stunt to get AI in their press release. It is a fundamental pivot in their entire business strategy. By embedding their service directly into the AI workflow, Angie can transcend the low-margin lead generation model. Imagine a user asking ChatGPT, "My sink is leaking, how do I fix a U-joint pipe?" The AI can diagnose the problem, realize it requires a professional, and then automatically pull up local contractor availability and pricing through Angie and literally book the appointment for you right there in the chat interface.
Angie completely transforms. They go from being a clunky, fragmented marketplace into an indispensable high-margin AI service orchestration layer for the physical home. They eliminate the friction of customer acquisition. If they pull this off, it justifies a much higher software-like valuation multiple for their stock.
However, for AI to truly run the enterprise and execute these autonomous actions, the industry has to solve its biggest fatal flaw, the hallucination problem. Major corporations cannot and will not trust AI to execute mission-critical workflows if there is even a small chance the model will randomly invent facts or hallucinate data.
Which brings us to a fascinating startup highlighted in the sources called Vericore. They are attacking the hallucination problem not by building a better brain, but by building a better management system. They use a multi-agent verification architecture.
Instead of relying on one single AI model to give you an answer, Vericore uses a system that pits different, competing models against each other. You would have Claude, GPT, and Gemini all working on the same problem. The system forces them to cross-verify each other's information, debate the data, check the math, and flag any inconsistencies before it ever produces a single, high-confidence output for the human user.
It's like having a team of analysts checking each other's work before presenting it to the boss. This creates a vital new middleware category in the AI stack. It's not about being the smartest AI, it's about being the most reliable. And right alongside reliability, privacy is becoming the massive differentiator.
We see this with a new tool called Prism. Prism operates as a local-first AI workflow extension. It addresses the massive corporate fear of uploading proprietary data to the cloud. Prism allows power users to manage and structure highly sensitive corporate documents and context for complex prompts entirely on their local machine.
So, zero risk of a leak. No proprietary enterprise data is ever sent to an OpenAI or Google server. The future of AI tools isn't just a smarter brain. It is a more secure, isolated, and verifiable system.
And as these secure systems deploy, we are seeing AI democratize highly specialized, previously gate-kept skills. The memo details a custom AI agent built to act specifically as a Buffett-style fundamental stock analyst. It can instantly ingest hundreds of pages of raw financial statements, earnings call transcripts, and global news feeds, and output a highly coherent fundamental analysis of a company's economic moat and management quality.
It automates the brutal, grinding research work that was previously reserved for armies of junior Wall Street analysts pulling 80-hour weeks. It puts institutional-grade analytical tools directly into the hands of retail investors. The value of simply aggregating financial data is plummeting to zero. The premium is now entirely on who can build the most structurally sound AI to interpret that data.
Yet, even as Silicon Valley spends billions building these sophisticated statistical models, the large language models, the bleeding edge of scientific research is already looking past them toward true biological simulation. The intelligence memo highlights a company called Eon Systems that has achieved something genuinely profound.
This blew my mind. Eon Systems successfully simulated the brain of a fruit fly, but they didn't do it by writing traditional AI code. They based it entirely on the fly's connectome.
For clarity, a connectome is the comprehensive physical neural wiring diagram of a brain. It is the exact microscopic map of every single neuron and how they connect to one another. Vion mapped this physical hardware into a software simulation.
And here is the unbelievable part. The simulated fly in the computer exhibited emergent, highly complex, biologically accurate behaviors. It knew how to walk, it knew how to groom itself, it reacted to simulated stimuli without any traditional AI training data.
This is a crucial distinction. They didn't train a neural network by feeding it a billion videos of fruit flies. They didn't use massive data sets. They simply perfectly mapped the physical structural wiring of the brain in a digital environment. And the software essentially woke up and inherently knew how to be a fly.
This represents an absolute paradigm shift. It points to a post-LLM world where we eventually move away from AI as just statistical word prediction and move toward true structural brain emulation. It physically proves that complex behavior is an emergent function of structural wiring, not just the result of processing vast data sets.
So why is this entire AI segment critical for you to understand today? Because the software suite you log into every morning for work is about to fundamentally break and be rebuilt around these autonomous agents. The very mechanics of how your company pays for technology is going to change. And if you are relying on a chatbot to help you figure out your 401k, you need to deeply understand the hidden structural biases that are quietly pushing you toward commoditized passive strategies. AI is no longer a toy. It's the new underlying infrastructure of reality.
And this incredible transition from artificial intelligence into true biological simulation perfectly bridges us to our final major section: frontier science, human biology, and how microscopic invisible data points are dictating massive macro trends in our lives. We're moving from the artificial brain to the real one. Let's start with a critical breakthrough in oncology, specifically regarding gastric cancer.
Gastric cancer is notoriously difficult to treat, often because the tumors become highly resistant to therapies. A major new study detailed in our dossier used advanced single-cell and spatial transcriptomic analysis. They closely examined 35 patients who were given a combination of anti-PD-1 immunotherapy and traditional chemotherapy. The researchers were trying to figure out exactly why these cutting-edge treatments fail in so many patients, and they successfully mapped out two distinct, highly specific biological mechanisms of resistance.
Okay, let's translate this into an analogy we can all grasp. Think of the cancer tumor as a castle that the immune system is trying to attack. What did the scientists find?
First, they found an intrinsic resistance mechanism that is present before the treatment even begins. This is driven by tumor cells, expressing specific proteins known as CEACAM5 and CEACAM6.
So these proteins are like the bouncers at a very exclusive evil club.
Exactly. These proteins act like a shield. They create what the researchers call an immune-excluded niche by actively recruiting macrophages, a specific type of white blood cell. These recruited macrophages essentially form a wall that exhausts and blocks the body's primary attack force, the CD8 T cells, from ever reaching the tumor. The castle has built an impenetrable moat.
But that's just the first defense. They also found a second mechanism.
Yes, they identified an acquired resistance that happens after the medical treatment starts. The tumor adapts. This adaptation is driven by an expansion of macrophages that begins secreting a specific protein called IL-1B. This protein triggers a broad, localized inflammatory response that helps the tumor mutate, survive the chemotherapy, and continue growing.
So by mapping this out temporally before and after treatment, scientists have fundamentally changed how we can attack this disease. They have nominated the CTAM bouncers as predictive biomarkers. A doctor can look at a patient, see those proteins, and know instantly that standard therapy won't work, saving crucial time. And they identified IL-1B as a brand new therapeutic target. If pharmaceutical giants like Merck or Bristol Myers Squibb can develop drugs to specifically target and disable these exact pathways, they could dramatically, fundamentally improve the survival rates for first-line gastric cancer treatment.
We also have groundbreaking paradigm-shifting research in the realm of psychiatry and neuroplasticity, specifically looking at the drug MDMA. A longitudinal study using highly advanced two-photon microscopy on live mice demonstrated that MDMA induces profound structural plasticity in the medial prefrontal cortex.
Meaning it physically changes the shape of the brain.
Yes, it physically increases dendritic spine density, the literal connections between neurons.
Yeah.
And they observed this rapid growth while the mice were undergoing a fear extinction learning protocol.
Let's unpack that. What does that actually mean for treating trauma?
It means the MDMA literally accelerated what researchers call representational drift. It caused a dynamic, physical remapping of the neural networks associated with fear. Put simply, MDMA physically helps the brain overwrite deeply entrenched trauma and fear memories. This provides the exact, observable cellular mechanism explaining why MDMA-assisted psychotherapy has proven so incredibly effective in clinical trials for treating severe PTSD. It opens a critical, temporary window of extreme plasticity where the adult brain can physically heal and rewire itself.
Now, I want you to hold on to that thought about a window of plasticity because we need to connect it to a completely different biological study regarding how we age. The memo details a transcriptomic analysis of mouse kidneys across a 24-hour cycle. The researchers were looking at circadian rhythms, our internal biological clocks.
And what they found is that aging fundamentally disrupts these rhythms. As we age, our cells essentially lose their timing. Specifically, aging decouples the canonical clock genes within our cells.
Think of your cellular clock like an orchestra. When you're young, the conductor is keeping perfect time and all the sections, the different genes play together smoothly. But as you get older, the conductor leaves and the cell loses its rhythm. What is the consequence of that?
The researchers found that cellular senescence, which is the process where cells age, stop dividing, and begin causing inflammation and age-related diseases, is not a static state. It is a highly dynamic circadian-gated process. As the temporal organization of our cells collapses due to aging, it increases transcriptional noise, which drives disease.
This raises an incredibly important question, and this is where the genius of triangulating this intelligence really shines. What happens if we combine the MDMA neuroplasticity findings with the circadian rhythm aging data?
You discover the potential for a chronotherapeutic window.
Mm.
If cellular senescence, inflammation, and basic brain function fluctuate wildly based on circadian rhythms, then the effectiveness of a powerful drug like MDMA might be entirely dependent on the exact time of day it is administered.
This is massive. The proposed experiment here is to administer MDMA to aged subjects at two distinct circadian time points, once when their internal clock genes are peaking and once when they are at their lowest trough, and then measure the resulting neuroplasticity.
If MDMA's ability to rewire fear memories is significantly measurably greater at a specific time of day, it unlocks a massive, low-cost method to dramatically improve psychiatric care.
Yeah.
Simply timing the dosage correctly could maximize the therapeutic efficacy and drastically reduce negative side effects, particularly for older patients whose baseline circadian rhythms are already heavily dysregulated.
We are talking about precision medicine based on the time of day. And speaking of timing in the brain, we also have a massive new study mapping the adolescent brain. Researchers sequenced over 88,000 nuclei to create a high-resolution microscopic atlas of brain development during the teenage years.
They discovered 36 specific gene regulatory networks that are hyperactive during adolescence. These networks are largely related to myelin remodeling, which is basically the brain heavily insulating its internal wiring to increase processing speed and efficiency as the child becomes an adult.
But the crucial, terrifying finding here is that these specific age-associated regulatory networks that are super active in teenagers perfectly colocalize with genetic variants linked to severe neurological diseases that don't manifest until decades later in life, such as schizophrenia and Alzheimer's disease.
This is a monumental discovery for the medical field. It suggests a shared fundamental molecular pathway between normal teenage brain development and your vulnerability to Alzheimer's when you are 70.
If pharmaceutical companies now know that these devastating diseases are actively seeded during adolescence, it completely changes the entire R&D paradigm. We might eventually move away from trying to treat Alzheimer's in 80-year-olds when the damage is done, and instead develop early life preventative interventions that protect those highly vulnerable neural pathways while they are still actively developing in teenagers.
And the profound implications of brain aging extend far beyond pharmaceuticals. They directly, immediately impact the technology sector. Another study highlighted in the memo found that as people age, their brains rely much more heavily on prior knowledge and context, what neurologists call top-down processing, to compensate for deteriorating sensory input, or bottom-up processing.
So when they tested older adults on navigating complex spatial scenes, they were significantly slower and more confused when they couldn't rely on familiar, established context.
This dictates a massive, mandatory shift for user interface and user experience designers across the tech industry. If you're building a software application intended for seniors, you cannot use novel, complex, constantly changing layouts or trendy hidden menus. The aging brain gets quickly overwhelmed trying to process new sensory data. You must prioritize absolute consistency, deep familiarity, and clear contextual cues. Leveraging existing mental models isn't just a nice-to-have aesthetic feature for the elderly. It is a strict biological requirement for usability.
It's so fascinating how invisible biological imperatives dictate how we interact with the world. And speaking of invisible data dictating our reality, let's talk about the grocery store. We have to look at how hard scientific data is increasingly overriding human observation in the business world, with profound effects on global supply chains.
The sources detail a fascinating story about the UK supermarket chain Waitrose. They recently enacted a total ban on the sale of mackerel.
Mackerel, a completely standard, everyday fish. They banned it due to ESG environmental, social, and governance sustainability concerns. Waitrose cited scientific data from the International Council for the Exploration of the Sea, or ICS. The scientific body claims that mackerel stocks in the North Atlantic are being extracted much faster than they can recover due to overfishing by massive international industrial fleets.
Yet this creates a profound, highly visible paradox. While the official ESG science classifies the mackerel as endangered and unsustainable, local coastal observers and recreational fishers up and down the coast report that the fish appears incredibly abundant. To the human eye, the oceans seem teeming with them. The discrepancy lies in the lack of agreed-upon international quotas between countries, creating a bureaucratic tragedy of the commons that the scientific models are flagging, even if the fish are currently plentiful.
But the business reality is that the invisible scientific model completely won out over the human eyeball. Waitrose pulled the fish from the shelves. And this creates a domino effect. It forces other major supermarkets to follow suit to avoid the dreaded ESG backlash, causing immediate cascading supply chain disruptions and sudden price volatility for substitute fish like herring and sardines.
The broader application here is critical for investors and corporate managers. Corporate decisions, supply chain integrity, and basic product availability are now entirely dictated by invisible ESG scientific data sets, completely, regardless of local, anecdotal human observation. An agricultural giant like ADM or a fertilizer company could face sudden, catastrophic sourcing disruptions simply because a third-party, international scientific body quietly downgraded the sustainability rating of a core commodity based on a complex algorithm.
So to bring it all back to you, from the deep, microscopic biological mechanics of how your brain ages and processes trauma, to the invisible scientific data points that literally dictate whether you can buy a specific fish at the grocery store on a Tuesday, frontier science is actively shaping the parameters of your daily life and the global economy.
It has been a truly massive journey today. We have synthesized an extraordinary amount of intelligence to construct this picture of the triangulated reality.
We started with Gen Z mall rats, proving that the deep human desire for physical, social experiences is actively overriding the convenience of e-commerce, creating huge opportunities for premium real estate while simultaneously driving the death of fast, free shipping.
We untangled the complex web of the Dolan Empire to show how the valuation of a beloved New York sports team is secretly, inextricably tethered to geopolitical stability in Abu Dhabi, proving that corporate structure and counterparty risk matter far more than brand prestige. We observed how the FTC is blending mainstream corporate enforcement with ideological targeting, turning political allegiance into a core, quantifiable business risk.
We learned to look past the mainstream crypto hype to see the insider selling and the dismal prediction market odds, learning that platforms like Kalshi are actively courting female pop culture fans just to truly capture the actual wisdom of the crowd. We saw how autonomous agentic AI is threatening to disintermediate the entire SaaS software industry, while inadvertently acting as a massive unpaid sales force for BlackRock's passive index funds.
And we explored the bleeding edge of biology, from the chronotherapeutic windows for treating PTSD to the terrifying realization that Alzheimer's vulnerability is seated in the adolescent brain, and how algorithmic ESG datasets are preemptively disrupting global food supplies. The overarching fundamental lesson here is that being truly well-informed requires an unrelenting, disciplined commitment to looking past the headline narratives and ruthlessly interrogating the underlying, often hidden structural data.
And before we let you go, I want to leave you with one final, deeply provocative thought to mull over. This builds on an incredibly dense academic paper buried deep in our sources. The paper is titled Overarching Programs That Frame Episodes of Focused Cognition. The research in this paper shows that the human brain manages complex, multi-step tasks by instating and then dismantling a single overarching neurological episode program. Essentially, it's a massive resetting of neural activity across your entire cortex that frames a goal as a distinct, autonomous unit of thought. Your brain works in episodes. Now consider what we just discussed in the tech sector. We are frantically spending billions of dollars building agentic AI to do exactly this, to autonomously manage complex, multi-step workflows, completely replacing human intervention in enterprise software. We are actively designing AI to operate in autonomous episodes of work. So here's the provocation. If human cognition fundamentally operates by framing tasks into discrete neurological episodes, and our most advanced artificial intelligence is now actively, deliberately evolving to mimic exactly that episodic autonomy to replace us in the workforce, are we no longer just building software tools? Are we, right now, actively reverse engineering the very architecture of human consciousness into silicon? Something for you to ponder until next time.